All right. My name is Chris Campbell. I'm a practicing CPA and I work with small businesses and individuals to help them pay the least amount of taxes possible while keeping them out of jail. So today I wanted to talk about taxes that get triggered or obligations that you may have when you have remote workers. I've worked with a number of companies, pretty much all the rage now, especially since the pandemic, where there's no physical office, right? So you have a number of different remote workers. It's something that I actually employ myself, where you simply just don't have a physical office and you have folks located in different places. What happens, and it's what I want to talk a little bit about today, is what's triggered and as far as the obligations that you have to different states, right? Because sometimes you have folks that work remotely, but they're not necessarily in the same place geographically. My talk today is not necessarily geared more to that. It's more so when you have folks in different states, right? Because there have been a number of times where I have clients where their company is, I'll just say, for example, that might be a Delaware C Corp, and they are based out of New York City, but then they have another employee that might be in California, and then another employee that might be, let's say, in the Midwest somewhere. So in circumstances like that, you have employees located in different states. And as a result of that, it could trigger a number of different obligations. And sometimes you might be surprised that it's triggered, but nonetheless, yes, they are obligations that you have. So 3 specific obligations that you may not know about that may get triggered as a result of having remote work. Now, another thing, when I say remote workers, these are specifically employees and not contractors. So I will leave that as a caveat. So I guess one way you want to work your way around a lot of these obligations is when you bring folks on board, if they're a contractor, some of these things, I should say, that you don't have to worry about, or it's a lot easier to slide by it because you're not on record as having employed anyone there. So the first thing you have to keep in mind is payroll taxes and unemployment insurance that you have to account for. If you have a remote employee, again, employee, not a contractor, you do need to register for the payroll in the state that person is in. So you are deemed as having an office for that person's state. So you do need to register with the state payroll. Their state income tax is withheld if they're in a state that has income tax. But most importantly, they want you to pay the unemployment insurance, right? So in the event that person stops working with you, they claim unemployment. They get unemployment from the state that they're located in and not necessarily your state, right? So make sure that when you get an employee, you got to go through, even if you have no other operations there, you got to register your company with the state, register with the Department of Labor there, and make sure you owe the taxes in that state accordingly, if employment insurance accordingly. So that's one obligation. The other obligation, and I've discussed this a little bit before, are sales tax obligations. So I've done videos on this before where if your company doesn't have Nexus, what's called a Nexus, or what they call economic Nexus in that state, then there's a number of thresholds that your company must meet in order to owe sales taxes. So for example, if you are an online retailer and you sell a number of things through the internet, if you don't have an office in that state, warehouse in that state, then there's usually a threshold that you have to meet before you owe sales tax. So it's like a couple hundred transactions and or $50,000. Every state is different that you have to meet over the course of the year, 200 transactions a year or $100,000 over the course of a year, calendar year, before you owe sales tax. Now, the key here is that if you don't have Nexus there, so Nexus being that if you don't have any sort of physical presence in that state, then those thresholds apply. If you do have what they call physical Nexus or economic Nexus, even a remote employee, even though they work out of their home, you are considered to have physical economic Nexus. So those thresholds go out of the window as far as, let's say, sales tax. So you have an remote employee in said state from $1 in those states, you'll owe sales tax from the first sale that you make $1 going forward because you have Nexus. So those thresholds don't apply. So that is one thing that a number of people get confused about because they think that, oh, I'm based out of, say, state New York. I may have a couple of remote employees, but hey, I'm based out of New York. So the sales tax don't apply to me until I hit the thresholds. And again, that's wrong. The minute you have an employee, remote employee, and again, employee, not a contractor, you have Nexus. So you got to start paying. So with sales tax, Obviously, it has to be stuff that you can sell. It has to be applicable to items that are subject to sales tax, right? So not everything is subject to sales tax. Most services aren't subject to sales tax. So it's really items that you're selling. Most of the time it's physical items. Some states do tax some services. So you got to check with your state to see what is considered subject to sales tax and what is not. So caveat there. All right. Third thing, and this would be corporate or / franchise tax. So you are operating an S Corp, C Corp, you need to an extent a partnership, state allocations. So different states have different methods of allocating, in the sense that sometimes based upon your sales, sometimes it's based upon your payroll. You're supposed to allocate your income amongst the different states that you operate in. So there's different formulas about it. So every state is different, but sometimes you have formulas based upon the sales in that particular state. Sometimes you have formulas based upon the payroll. And that's where this comes in, is that if you have a state that wants an allocation done by the payroll of all employees, then you may be subject to having to file and pay the corporate return and corporate taxes. So now I know, like with an S Corp, the company itself doesn't pay income taxes, but in most states, the company from corporate level, they're subject to franchise taxes. So even if it's not a straight up income tax, if you do have payroll in that state and you get a certain threshold based upon how they click, you might be subject to at least franchise tax in that state. So yeah, definitely you want to keep that in mind. So those are the three things that you should take heed to when you bring on a employee that is outside of the state that you operate in. All right. So I think that should do it for now. Hopefully this was helpful. And if you have any more questions or comments about this topic or any other tax or account related questions, feel free to reach out. I'm happy